Hello, you're watching Dukascopy TV. Today's latest UK inflation data was predicted by the City, and although it is still way over the guideline 2% mark at 2.7%, just witnessing any kind of reduction is being seen as very positive for the country's economy. Well, on the line now, I'm joined by Mike van Dulken, Head of Research at Accendo Markets. Mike, this latest inflation data continues to show a UK economy on the mend, but it came out softer than expected. Good news for Governor Mark Carney?
Yeah, it's been softer across the board, bar RPI, the retail price index, which is, I think the focus is more on the consumer price index, slightly different makeup. The CPI is the more focused one. As I said, softer across the board. Input prices are lower, which is nice to see. That's so for companies, factories, etc. They're able to get their components in more cheaply. Output prices also a bit lower, and I think this is a function of the stronger pound of late, which is itself a factor of Governor Carney's forward guidance being ignored, if you like, markets factoring in a rise in rates earlier than his guidance is signalling. So that stronger pound is helping in terms of buying things, but it's also hindering in terms of selling things. Thankfully, it's helping more than it's hindering. And if we look at the PPI output prices on a core basis, they're just a tad softer. House prices also, that data also came out at the same time. That was a touch lighter, which is maybe another good thing in terms of markets having been worried about a bubble situation in a market, helped by initiatives brought in by the government.
There'll be a vote tomorrow on interest rates. Are the markets expecting a vote for a hike, or is the 7% unemployment target until rates are lifted strategy likely to hold?
Yeah, I don't think there'll be any major change, especially with a slight cooling in inflation is good to see. If anything, if we see a continually weak dollar, that's likely to keep benefiting sterling, which is likely to maybe keep up the pressure and maybe keep inflation down a touch. So that may give Carney a bit more breathing space. Not just Carney, but the committee a bit more breathing space for another month. So it's probably a case of still wait and see, unfortunately, for a bit longer.
You mentioned in your first answer better input prices for businesses as a result of this inflation data. Some economists are expecting growth to hit 1% in the third quarter. Now, this will sound appetising for policymakers, but small to medium-sized business won't feel any of the benefits of such growth, will they?
No, I mean, they're likely still being squeezed a bit like consumers. So you've got probably a bit of a lag in terms of that flowing through, and it may well be that they don't see the benefits of that for another quarter or so.
Finally, Mike, if in the next inflation report we see further rate reductions in the coming months, can Mr Carney realistically keep rates at an all-time low for as long as 3 years and convince the markets it's the right thing to do for economic growth?
I mean, it's one thing him being explicit about rates staying low for a certain period of time. It's another whether markets believe him or not. But I think that he's given himself such a lot of wiggle room in terms of if this happens, if that happens, his knockout clauses, etc., that I still see rates rising a bit earlier, maybe not quite as early as the markets are expecting, towards the end of next year or early 2015, but certainly earlier than the end of 2016 that he's signalling. The employment situation is still kind of improving, but whether it's improving enough, I'm not sure. The makeup of employment is still of a level that's conducive of a true economic recovery. We're still dealing with the highest inflation of the major central bank countries, and that's still squeezing consumers significantly in terms of the high 2% consumer price inflation versus very limited wage growth is extremely difficult to deal with, and that's likely to still weigh weigh on the economic recovery. I mean, it's one thing fueling the housing market, but through initiatives. But again, if that gets out of hand, that will need to be dealt with, and that will just have a negative impact on any ongoing recovery. So that will have to be dealt with quite carefully, I would imagine, over the next few quarters.
Well, that just about wraps it up for now. If you want to know what other topics we're covering today, head to the Dukascopy TV homepage and watch as much content as you like for free. Until next time, though, enjoy your day. Bye-bye.